Welcome everyone to our webinar for today, where we will be covering managing transfer pricing in Malaysia. So we thought this is quite a relevant topic at this time of the year, given that we are very close to finalize in most taxpayers the audit financial statements in Malaysia. From July onwards, taxpayers will have to submit their tax return. Now, why is this important and what is the relationship with transfer pricing? That essentially a lot of the items that are used in any tax computation will have a direct link in the way in which the company approach the pricing of control transactions. Also, as we will see today, there is some disclosures in the tax return that are related to transfer pricing, and hence it is important for every taxpayer in Malaysia to be ready by the time that the tax return is lodged with their transfer pricing documentation, and we will see that through today's webinar. Before we get started, for those who are new, let me just do a brief introduction about our company. So our firm specializes in providing practical, proactive, and cost-effective transfer pricing advisory in the Asia-Pacific region. We have 3 offices located in Australia, Singapore, and Malaysia, from which we cater to multinational groups in the Asia-Pacific region. And apart from that, you will know, because some of you have attended to all of our webinars, we're very passionate about sharing what we know, and we like to share it in the form of our webinars and also in the form of contributing to articles to industry journals. So before we start with the topic, for those who are new, let me introduce our speaker for today that will be with me. Hon Chuan Tan, who is the technical lead of our Malaysia office. Hon Chuan Tan has over 10 years of experience in transfer pricing and indirect tax. He has played a key role in pioneering and developing transfer pricing practices in Malaysia. Before joining our firm, he was in one of the big mid-tier firms, and we are fortunate enough to have him now with us. He has extensive experience in transfer pricing planning and risk management, and in all variety of transfer pricing advisory, including transfer pricing documentation, country-by-country reporting, tax-effective supply chain in the Asia-Pacific region. And for those of you who don't know me, my name is Adriana Calderon. I'm the Director and Technical Lead for Transfer Pricing Solutions Asia and Malaysia, and a co-founder. I have extensive experience in the area of international tax and transfer pricing, working before with Big Four and mid-tier firms, advising multinational companies in the areas of corporate and international tax across South America, US, Australia, and the Asia-Pacific region. So with that, let's kickstart our topics for today. So I guess the key question that we were asking ourselves when we put together this webinar was, okay, is everyone in Malaysia aware of all the transfer or all the compliance requirements that are associated with transfer pricing? And the reason is because the requirements are usually kind of split in different areas of tax. And we thought it would be worth coming back to basically summarizing what is it that a taxpayer in Malaysia needs to be aware of when it comes to managing transfer pricing in Malaysia, and specifically what to be aware of and what the Malaysia taxpayer has to prepare. That's why we will be covering today first what it is transfer pricing documentation for Malaysia and the different versions that are available or are that the Malaysia taxpayer needs to look into, followed by the related party form that taxpayers need to complete as part of the tax return. And third, we will be talking about the one very important requirement, which is country by country reporting in Malaysia, and what is the requirement in the context of Malaysia. So with that, I pass it on to Hon Chuan to give us some insights on what it is and how do we see, or how do we approach simplified versus full TP documentation in Malaysia?
All right. Thanks, Adriana, for the introduction. Simplified versus full TP documentation. I guess this is our most frequently asked question by clients, potential clients, as to what is TP in Malaysia and what's the difference between the simplified versus the full. Before we drill into that category, let's look at what deems TP in Malaysia. The rule of thumb is we'll be looking at arm's length principle, right, which is the international standard, which involves looking at the substance, commerciality of transactions and arm's length price. Now, in layman terms, how we describe arm's length principle is that think of a way when you have control transaction, and that when would an independent party transact in that particular transaction at that particular price, right? So that's the question that we need to ask ourselves, whether within your control transaction, that is what's happening. Therein lies the arm's length principle. And, the RRB follows about 80-90% of the OECD TP guidelines. And in order to test and prove whether your transaction is in line with the arm's length principle, then taxpayers are required to prepare and maintain contemporaneous transfer pricing documentation, right? So that's the rule of thumb in terms of transfer pricing. Now, once we know this, then the next slide will be looking at who is responsible for preparing TP documentation, right? When we look at TP in Malaysia, unfortunately, all Malaysian taxpayers that has entered into a controlled transaction. And here, when we talk about controlled transaction, a simple way to know whether you have controlled transaction is when, if you look at audit account, right? Scroll down to note 17 to 20-ish, depending on your audit accounts, where you have a disclosure of significant related party transactions. If you have that section, you automatically, it okay means that you are required to prepare TP documentation. So in Malaysia, the controlled transaction includes both cross-border and domestic, right? So in other jurisdictions, it may be cross-border, but Malaysia includes domestic as well, right? Your local company transact with your local company. Now, there is an exception when you only have domestic transactions in place, is if both entities are accessible and chargeable to tax in Malaysia, and if any adjustment made will not alter the total tax payable or suffered by both persons. So in essence, if your effective tax rate is not the same for both entities, you will then not have this exception. So if you have tax incentives, if you have losses, again, you will not have the exceptions in place, because then you will not have a same effective tax rate. So bear that in mind. And if you do, please then assess it, and then if possible, then justify and document it down somewhere that we have gone through this process. We are both accessible and chargeable. If you make adjustment, it will not alter any of our tax payable, right? So you can document it down as well. So now that we have known who is actually responsible for preparing a TP documentation, then next question would be, then when would you then prepare this TP documentation? when I mentioned earlier, the contemporaneous part is very important. Now, what does contemporaneous mean in this purview is when you're setting up a controlled transaction or when you are developing a controlled transaction. So when you have that plan in mind, right, you would most likely have to prepare a TP documentation to actually understand the control transaction, the pricing policy behind, to then prepare the TP documentation beforehand, right? And on the second note is if when at the latest, by the time your tax return is lodged, right? So sometimes you may have a control transaction in place, you have TP documentation prepared, but then during the period where you prepare the TP documentation and the time that to launch the tax return, if there are any changes to the business structure, to the pricing policy, anything that would impact on the TP position of your company, then you will need to then alter your TP documentation for it to be contemporaneous by the time you launch the tax return. Okay, so now that's the timeline. Now let's look at the frequently asked question, the difference between a full TP documentation and a simplified TP documentation. The threshold in Malaysia is if you have above 25 million worth of annual revenue and related party transaction worth more than 15 million, then you are required to prepare a full TP documentation. Or if you're providing a financial assistance of more than 50 million for non-financial institutions, then you really need to then look at and test this financial assistance on the full TP documentation point of view. And then taxpayers that fall below these two thresholds then can opt to prepare a simplified TP documentation. All right, so in terms of you're looking at the key differences in having full TP doc versus simplified, right? What's the difference? If you look at full TP doc, you obviously then have to specify all the criteria set in the Malaysian transfer pricing guidelines, which has your organizational structure, the nature of your business, market conditions, your industry analysis, then talking about your controlled transactions, and then the pricing policies in line with the controlled transactions, after which you have your assumptions, strategies, information regarding factors that could influence the setting of pricing policies for those controlled transactions, comparability, function analysis, and risk analysis, selection of TP methods, application of TP methods, and then obviously at the end, you have financial information, but also importantly, the economic analysis, which is when you apply TP methods, how you come up with the results itself. Now, if you look at the Malaysian TP guidelines, it says that taxpayers that fall below the threshold, they are only required to prepare ACD, right? Which is organizational structure, control transactions, and pricing policy. And then subsequently, it stated that the taxpayer would need to apply any other methods on top of the 5 TP methods that they deem most appropriate, right? So if you are preparing a TPD anyway, I would imagine you wouldn't want to engineer a new TP method to actually apply to test your control transaction. So I'll imagine NH itself would still be applicable in simplified TPD to apply a TP method. It may not be the 5 methods, but obviously most likely you need to go through the TP methods to find the most appropriate ones instead of going through the selection method. Now, then that's where the misconceptions lies, which I guess it will be on the next slide. Yeah. So therein lies the common misconceptions where I've been told again, I've been asked. So in the TP guidelines, the RB or LHDN says I only need to follow the ACD. That's it. And apply some methods. And I don't need to actually sort of test to make sure that it's arm's length. I don't need to do any benchmarking whatsoever. As long as I follow that ACD and apply some method, that's fine. So that is another question that we ask a lot, and every time I have to explain to them that, again, the guidelines are guidelines. And if you fall back to the Malaysian transfer pricing rules, which is gazetted in the ITA, right, that it stated that taxpayers that have entered in a control transaction will need to satisfy the arm's length principle of your company, of those transactions, which translates to any taxpayers, be it full or simplified, you will still need to make sure and test the arm's length nature of your transaction so far that it complies with the arm's length principle within the transfer pricing rules, right? So which means that you need to apply TP methods, you need to look at what benchmarking to be performed. Benchmarking in this case may be searching for comparable searches, or you may be using other methods to benchmark your control transactions against a comparable independent transaction, right? So regardless, you still need to test and make sure that you arrive at the conclusion whether your control transactions are transacted at arm's length or not, right? So that's the main thing that you need to work on, which means, again, another question that I've been told was, oh, I was looking at this simplified TP documentation, and I was informed that I can, I view most I can prepare myself. I want to try and see whether I can prepare myself or not. So it is for those that, again, you want to prepare yourself, it may be possible. Then again, you need to relook at the sections that need to comply, whether you have the expertise to actually test the transaction and make sure that it's arm's length or not, right? That's the key area where RB will be looking at. And then obviously leading to the 14 days, that is, you know, I'm gonna do a wait and see approach. 14 days, 30 days or 14 days. I think 40 days is still okay. 2 weeks, give you information, prepare a TB documentation, and get it right at that point in time. In our experience, it's most likely not the case. When RB comes in, conducting a TP audit or even a tax audit, requesting for TP documentation to prepare a complete TP documentation in 14 days is virtually not possible, because if you do it in a rushed manner, you may actually open up more issues than need to be.
Thank you, Honchun. So you want to talk about a little bit about benefits and penalties for non-compliance?
Yeah. So I think it's good to have this benefit part out of this. So I just want to make taxpayers or companies aware that, you know, there are a lot of benefits when you actually prepare and maintain a contemporaneous TP documentation. The obvious one would be the penalty protection, right? So once you have TP documentation prepared, then you would then be protected against the 14 days failure of submission of TP documentation. But then again, you have to make sure that it's contemporaneous at the same time of good quality. Secondly, it reduces the risk of audit and dispute with RB, right? So here it goes in line with the disclosure in the tax return where you declare, and looking at your RPT forms versus the declaration as well, to sort of prepare the TP documentation at the same time, reduce the risks as well of audit. If let's say you have a good quality, you when upon request, you actually provide to them, right? Generally, it starts from either a review or a tax audit. And if it's of good quality, has no disputes to be raised, then you're safe, right? So that's one of the good things about having a good quality TB documentation. And then the thirdly, which is explain taxpayers' position to RIBM. So I like to think the TB documentation as like a storybook, right? So we're telling a story to RIB in terms of our transfer pricing position, right? So basically, we portray ourselves as a good storyteller, telling a story to tell RIB that, hey, everything seems okay. It's a fairy tale and it looks good. Everything is as per question, reflected in the audit accounts. Everything looks fine. That is how that TB documentation works, right? You can't just look at the requirements and then put in some similar facts in there and then not tell the overall story, right? A good quality TB documentation is not about putting facts in. It's about telling a good story to the RIB to understand where they're coming from, to actually answer their questions before they raise the question, right? I'll imagine that a good quality TB documentation would have all the answers needed to answer the RIB without them asking you, oh, why do you have not this? Why is it this way, right? Why are you loss making, right? So a lot of questions can be answered within the TB documentation if prepared accordingly. Then the fourth one, obviously resulting to a minimized penalties in the event of an audit adjustments. Unfortunately, for those that have dealt with RIB when they have a TP audit in mind, obviously in their mind, they would have a adjustment in place, right? They have their KPIs to be achieved. Then the TP documentation will act as a defense mechanism to at least tell the story and then justify whether, on the RIB's point of view, whether they are correct or actually our view is of a more accurate way to describe the taxpayer's position, right? So in that case, then you can justify, go through a series of discussion with the RIB at the end, minimize the penalties if everything is actually prepared accordingly. And second last would be, obviously, it's good effort and it's recognized by the RIB, right? I've actually attended a few conferences with RIB personnel in there. One of the comments by the RIB officer is that a lot of times taxpayers, they do not provide documents, work papers as requested. They do not formalize contracts. They don't have any good quality TB documentation. They don't have a full view of the taxpayer's position. Hence, if you have a TB documentation as well as working papers, contracts, everything in place, this shows good a reasonable effort has been made that you have actually looked into your transfer pricing correctly, and that RIB will be looking at, oh, hey, that's a good practice, and it may drop the guard to look at your TB documentation, so to speak. And lastly, on a planning tool, I think this is also very important feedback is that taxpayers always think that the TB documentation is more of a compliance-based work, and that is just that, like your tax computation, but it's actually the TP documentation itself and the process of the preparing TP documentation, the process of going through that with your consultant is a good planning to first look at your overall risk, TP risk position. I'm not talking about just TP, it may lead back to indirect taxes or other corporate taxes as well. And once you've completed that, you would have an overview of what's happening within the firm and what are the risks in place, what are the recommendations, whether upon that, what are the findings from the preparation of TB documentation for you to then use those knowledge to better prepare or better plan your supply chain, your maybe restructuring based on other developments within other jurisdictions as well. So it is good to use the TB documentation as a planning tool. right? Because it involves all kind of analysis going through your company, going through your industry that you may not have full view on. And once you have the industry analysis, you have actually better view of doing your business, maybe. And then going through your function analysis, whether on substance wise, you have that in place. So at the end of the day, it's always good to have a contemporary TP documentation in place to make sure that, it's not just left on top of the shelf somewhere. It's more to it for you to use it and to understand as well, right? So bear that in mind. All right. I think, yeah, this is where, which leads to something that you want to avoid, right? Penalties for non-compliance. This is where with recent, not that recent, it's 2021. So we are now well in 2023 already, that, they have introduced the 14 days from 30 days, and the penalties goes from 20,000 to 100,000, including imprisonment, right? On top of that, if you have a TP documentation, then if you do not have a good quality TP documentation, what's the risk of non-compliance? You have additional corporate tax payable given, penalties ranging from 20 to 50%. Upon adjustments, if you can't really justify your TP position. And on top of that, previously, depending on your tax payable position, if you're in tax losses, then really penalties will be lower. But now they introduce a surcharge of up to 5%, regardless of whether you're in a loss position or not. 5% will be upfront taken out from your TP adjustments. Then you can justify, go through your audit process and see whether you will actually be able to justify your TP positions or not. So please be aware that the penalties are actually quite hefty, right? This goes in line with those that are thinking of preparing a TP documentation yourself. Again, my advice is, if you have the expertise in TP documentation, by all means, you can prepare it. If you do not have a TP documentation, and I get this a lot, your superior, your management is actually trying to save costs, right? To say that, hey, you as a finance manager, do you have to actually prepare this TP documentation? Just look at the TP guidelines, some rules, maybe look at the OECD TP guidelines if you're able. I think that's like how many 1,000-ish pages or 700-ish pages. And then to test it whether it's an arm's length. Based on my experience, we have a lot of these cases where they come back to us and redo the whole TP documentation, because it's not that you don't know how to do it. It's just that the experience to make sure that what IRB is looking for is not there, and you sort of do not know how to gauge what IRB is looking for. That's where it may be more detrimental to actually prepare something yourself without the expertise. And if you look at it, the penalties, if you look at the adjustments and the 5% TP adjustments, does it then really, is it worth it to actually then go through yourself, or actually then seek external consultants and look at the fees and see whether cost versus benefit wise, is the penalty is going to be above your fees, or the fee is going to be below or above the penalties. I think more so that the fees will generally still be below the penalties. Hence, there will still be savings in there in the event of audit that you get it done correctly.
Thank you, Hon Chuan. So before we move into the second segment and talk about related party form as part of the tax return, please, if you have any questions, post them in the Q&A box that we have in Zoom, and we will be happy to answer at the end of the webinar. So related party form as part of tax return. I always call this requirement as an underdog requirement, because it's often overlooked the impact that it can have in a taxpayer, because of the way in which the regulations have been draft or the way in which the requirements have been put in place in most countries in Asia, but let's talk about Malaysia in particular, most of the documentations do not need to be submitted. So Malaysia follows the same approach as most countries in Asia. But what you do have to submit is the details of the control transactions that you have entered into during the year. So for that, each country has its own version of this form. So essentially what the related party forms aim to achieve is to allow taxpayers, in this case IRB, to be used as a risk assessment tool to understand what's the transfer pricing position of the company. So we will see a snapshot in a moment of the form, but if you see it, it will inform IRB very clearly on the control transactions that the company has entered into. So it provides a very clear snapshot of all the transactions that the company entered during the year. And obviously, it needs to be filled correctly, because if it's completed incorrectly, it can trigger transfer pricing reviews and potential audits, because the information that is disclosed is what is used as the basis for IRB to pick up taxpayers for audit. So that's why we have to keep in mind that is the only information that the IRB has in hand about the company's control transactions. Now, if we see at the moment in Malaysia, all taxpayers that enter into control transactions need to complete the related party form as part of the tax return. So this includes domestic and cross-border transactions. So not only cross-border, also domestic. And we'll see how it is declared. And the other thing is that the taxpayers need to declare very clearly if they have to prepare TP documentation. So they have to self-assess themselves on the obligation. And the second thing is, as you will see in the following slides, there is a lot more detail about characterization. And that's quite unique, I have to say, to Malaysia, because there is not that many forms, but Honchan, happy to be corrected if I'm wrong, but there is not that many forms that go into such a specific detail about the characterization. So now, why is this important? Because I guess the expectation is whatever it is declared in the form that is part of the tax return has to have consistency with the transfer pricing documentation. So let's see the form and I will explain what I mean by that. So if we see these questions, we will have first a very clear question of whether you are required to prepare documentation. My take on this is that you will have to answer always yes, because if you don't have control transactions, then you are not required to prepare documentation. But if you have control transactions and you have to complete the form, then the answer is yes. So I would be very curious to know of any taxpayer who has answered no here and still has disclosed values. So I'm guessing the only situation where someone will answer no is when you're actually not going to declare values. Then question 2A to 4B is quite interesting, because what the company is required to do is to disclose the activities that are performed in 2B, manufacturing, the type of manufacturing in 2B. 2A, manufacturing, and 2B, the type of manufacturing. 3A, distribution, and 3B, the type of distributor. 3A, the services, and 4A, the services, and 4B, the type of service. Now, I can foresee that a lot of people will struggle to answer this question, because a typical question that we will get asked is, okay, what do I disclose here? My business activity as per company's commission of Malaysia, or my transfer pricing activity? Because a lot of the times, the characterization for transfer pricing purposes is not the same as the business activity as per my registration before Companies Commission of Malaysia. So that will be the first struggle, where I will say that one needs to look at these questions in the context of the transfer pricing documentation. And it is very specific on the characterization, because it really goes down to the standard characterizations that we understand, again, for transfer pricing purposes. So I can foresee here, I give an example to be, maybe a person who doesn't know transfer pricing or hasn't done documentation will struggle to select the type of manufacturer. And what's the difference between toll manufacturer and what's the difference between contract manufacturer? The same goes with distribution, because these are characterizations that are quite unique to TP. So what is a limited risk distributor versus a commissioner distributor versus an agent distributor versus a licensed distributor? And what is the profile in terms of assets, risks, and functions of that entity, to choose one after the other? So I think for these questions, taxpayers will struggle to complete without a proper TP documentation in place. Because just to be clear, this refers to characterization for TP purposes. Then we have question 5, where we have to answer whether there has been a business restructure and the nature of the business restructure. And again, this comes back not to the business restructure that we understand for normal purposes, such as changing shareholding, changing structure, etc. We're talking about business restructure where the characterization of the company changes from one to the other in the context of manufacturing, distribution. Again, I think if someone will have to say yes to this, it will struggle to understand what type without any proper documentation. Then we have, for some reason, I'm trying to move the slide and it's not moving, as we do. Okay, there you go. Then we have question 6, which talks about whether the company performs any R&D activity. And if it does, then it has to state again the type of R&D activity. Then question 7, where we have to disclose again the ownership of intellectual property. And then again, is this an accounting ownership or is this TP ownership? Because again, we have the same issue that TP intellectual property definition, ownership is totally different to the accounting definition. So I'm guessing that we have to go here with the TP definition because these are related party form, but then a bit of a struggle without documentation. Then question A and AB are questions around cash pooling activities and whether the company is within a cash pooling arrangement and what type of cash pool participant is. Then question 9, whether the company has declared or paid dividend. Question 10A, again, are you a permanent establishment as defined under transfer pricing rules? Which is a bit of a strange one because one will think that the permanent establishment definition will have to be defined first under tax rules than TP rules, but nevertheless, we will have to answer this question. Then question 10B, whether do you make any interest, royalties, and services payments to head office? So any expenses associated with interest, royalties, and services payments? Then the answer yes or no. Are you involved in cost contribution arrangements? So then we have again another, like a lot of detail that needs to be answered yes or no for TP purposes. Then we have, this is part A, as you see already 12 questions that are very, very transfer pricing driven. Then we have part B, which actually is the detail where the taxpayer declares the values. And it has to separate the values within Malaysia, outside of Malaysia, and the income side versus the expenses side. So the expectation is that any income or expenses that are associated with control transactions are disclosed here in this part B on a gross value level. So as you can see, I won't go into detail, but you can see that you have to separate and classify the transactions by type of transactions, whether it's sales or purchases, payments to intangibles associated with royalty, license, or any other payment, management fees, and any other type of services different to research and development, advertising, marketing, and promotion, tangible assets, and rent and lease. I think that we could very well do a whole session on going through the related party form of Malaysia in detail, because there is so much that a taxpayer needs to disclose that honestly, even understanding what is the expectation of these answers can be a bit of a struggle. But the point is that this point, part B, is all about disclosing gross values, items of income, and items of expenses, and separated in Malaysia or outside of Malaysia. The following part refers more to other type of transactions, such as loans, interest, guarantee fees, cost contribution, dividends, payments to head office, if you are a PE, sales of IP, and any other not specified. So it is a lot. Part A is all about answering yes or no, or the characterization. Part B is all about disclosing the values by type of transaction. So as you can see, it's quite detailed. And at the end, the taxpayer will be saying a lot and disclosing a lot to the IRB. And this information will be used as the basis for basically choosing taxpayers for audit. So that's why I guess the reason and why would tax authorities, and in this case IRB, develop this form is as a way to basically assess which taxpayers have transfer pricing risks, whether they are enforcing and whether they can enforce compliance with the arm's length principle, and obtain a very granular details on cross-border transactions versus domestic, and a level of detail that is not available in the financial statements, which will give visibility and transparency to be able to conduct audits. So the question is, if I disclose and I prepare such a lengthy and long form, what will the IRB do with the form? So essentially, they will use the information to select risky taxpayers in the context of the value of the transaction, whether the taxpayer has commercially unrealistic level of profits or several years of losses. And then understand as well if the taxpayer requires to prepare documentation and what type of documentation. Something to keep in mind is two key things. One is the risky factors, and usually what we observe in our practice based on audits that have been conducted with our clients is that there is some key factors that usually lead taxpayers to an audit. One is the value of the transactions, and the value of cross-border transactions in the context of the business, whether the related party has transactions with countries with a more favorable tax rate, whether there is large or significantly swings of operating results over a period of time, so recurring losses or large swings between operating results not explained by the industry, transactions that involve intellectual property and intangibles, hence the reason why the related party form asks a lot of detail on this, and whether there is some development of IP as well. And that's why one of the questions is associated with there is IP and if the company is owner of IP. I think the last point that we need to keep in mind is what it is controlled transactions for the purpose of transfer pricing in Malaysia. And I guess the definition of control has been revised under section 148 to common shareholding of 20% of shareholding or more. And the operations of the affiliates depend on the proprietary right of shareholder of 20% or his affiliates, or the shareholder affiliates is able to influence decisions relating to the business activity of the company, including receipt of services and the pricing of the acquisition of such services, or one or more of the directors of or members of the board of directors of a person are appointed by the shareholder and affiliate. So it's very important that we look at this in the context of shareholding percentages and the possibility to influence decisions. So this is basically the definition that should be followed for the purpose of control transactions, also for the related party form. Honcho, and do you have any comments, or do you want to move on to country by country reporting?
Yeah, I just want to add on, if you look at the introduction of this, I mean, the increase of scrutiny on the RPT form, previously we don't have this RPT form in place, right? So when this RPT form is implemented, you can see that it serves as a risk engine for the IRB. They're trying to determine the overall taxpayers in Malaysia with controlled transactions. And if you look at how they structure it, right? If you look at characterization, for example, that characterization is actually just because they want to know when they target for audit, right? Generally speaking, they actually go by industry. So they'll maybe target manufacturer first. They have your risk engine looking at, okay, I'm looking at toll manufacturer first. Then from toll manufacturer, then they look at your financial position. Are you loss making? Then carry on and the value of the transaction. So in this scenario, that is a question that a lot of SMEs was talking about. Oh, I'm very small, right? So I wouldn't be in the radar of IRB. But now IRB will be able to look at in the industry and then look at your losses. If your losses, regardless of whether the value is high, then if they think that you are an easy target to just adjust, they can go straight to you, and knowing that you may not have that TB documentation in place, depending on how you declare your the disclosures. So yeah,
that's a very good point. So do you want to then finalize with country by country reporting in Malaysia, which is another, I will say, underdog in the sense that not too much in the radar, even though it should be.
Yeah. I guess on the basis was that, we would think that they don't fall within the country by country reporting threshold, right? That's where a lot of taxpayers think that, that it doesn't apply to me. But first, it's again a very important compliance within the TP. So it's good to then revisit country by country reporting in Malaysia, and you look through who does it apply to, what is country by country reporting, when do I need to lodge it, and how do I need to lodge it. Now let's first look at who is actually captured under country by country reporting. In Malaysia, for non-Narbonne entities, it is when your group is the threshold is RN 3 billion, right? If you are the holding company and your consolidated revenue is 3 billion, you fall under it. If you're part the constituent entity, part of the group that is above 3 million, you fall under it. If you are part of the group that's above 3 million and you are actually the designated surrogate entity to actually prepare country by country reporting statements, you are responsible, you are obligated to actually then prepare and lodge accordingly. And if you are a PE, but then and you have then part of the group that's above 3 billion ringgit, you fall under it. So now the one that I need to highlight now in terms of this 3 billion is that for Malaysian purposes, for Malaysians, you guys will sort of are aware that our Malaysian ringgit are weakening, right? So which means that you really need to then relook at your group, even if they are the OECD or OECD threshold is actually 750 million euro, right? So with the weakening of Malaysian ringgit, the overall group revenue may be less than that, maybe less than 750 million euro or less than maybe 1 billion. It was 1.1 billion Singapore dollars. So now with Singapore dollars like 3.4 now, so which means that it's even if your Singapore group is less than 1 billion, you may still be caught under this country by country reporting obligation, right? So then you really need to then liaise with your head entity and what's the approach to this, because then in other jurisdictions they may fall below their local threshold for country by country reporting, but in your case you may actually be above that 3 billion ringgit unless Malaysia is going to revise that threshold to a lower rate. So bear that in mind. So this is the non-Labuan one. And the next one is Labuan. So Labuan is similar. Just the difference is that if you're the ultimate holding company, you're obligated then also to prepare and lodge only the ultimate holding entity and of it constituting in Labuan, then you need to prepare that CBC report. So now you know who is obligated, then we go into detail on what is this so-called CBC reporting, right? So historically, it is actually based on the BEPS initiative, Base Assurance Profit Shifting, that introduced this country by country reporting on a 3-tiered basis, so that to sort of cover a global TP position of the group. So we have first the CPC report and the master file, and then lastly the local file. Local file will be your TP documentation generally. So in almost all jurisdictions, the local file will equal the TP documentation, except I think Australia. Okay, so if you look at CBC report, it's more or less an overview of the group, and an overview, but still in detail with your tax jurisdiction, whether the total revenue, profit and loss, income tax paid, capital, accumulated earnings, number of employees, looking at your substance, where your substance in either jurisdiction, maybe you have no substance in Cayman Islands, for example. So this will sort of give them an overview, the TP position that your group is in, and lastly the tangible assets. That's for table 1. And next will be table 2, where it looks more closely into the characterization itself. What does the company within a certain jurisdiction, what's the activities within that jurisdiction, and then into all the various jurisdictions. So to sort of relook at the overall supply chain and see where your entities are located and what activities they are performing within the supply chain. Then you have the master file. So the master file, we call it blueprint of the group, where it's an overview of what the group does as a whole, where they look at your organizational structure, your group structure, look at your group's businesses, what business lines you have across the group itself, then the group's intangibles, who is owning it, and what are the intangibles. Then you have your intercompany financial activities, whether you have cash pooling or your loan coming here from there, and what's the policy in it. Then you have your group's financial and tax position. So we have just overall looking at your consolidated figures, and as well as your tax position for the group itself. right? So all these are more on the overarching umbrella of the group itself. Then on local file will be your TP documentation. So now about filing obligation. Now, if you look at 3 tier, you have CBCR and master file. Local file will most likely be prepared locally. Then for CBCR and master file will be prepared by generally the ultimate holding company, unless the ultimate holding company do not want to actually prepare it, then they will need to elect a separate entity to actually prepare the CBC report as well as the master file itself. And to note that for Labuan entities, the obligation lies with the ultimate holding entity alone. And yeah, this is equally important for those taxpayers that think that, hey, I've got CBCR, but I don't need to do anything. Actually, that's not true. You actually need to then, for the holding company, for those that are obligated to actually prepare and file, you need to notify the Director General in writing of your responsibility. For those that are non-reporting, so for those that are not obligated to actually prepare and file, you should still need to notify the Director General in writing to inform them that which entity is the reporting entity that is obligated to prepare and lodge on your behalf, right? So you have a lot of entities, all these entities will need to then notify separately in one list. Yeah, always when do I need to lodge it? The rule of thumb is 12 months after your reporting financial year. So that's your filing obligation. And for CBCR notification, it's actually on or before the last day of the reporting financial year. So it's very different from your filing obligation. So keep that in mind. Your tax agent, hopefully they will then inform you that you need to notify on your CBCR. And finally, if you are obligated to prepare and lodge, Malaysia follows the OECD format, which is a XML schema based on OECD. And once you have to prepare the CPD report, you need to then convert into a XML format based on the schema, and then using this schema to lodge into the LGN tax portal, right? So that's important. And again, with TP, CBCR, it's equally hefty, but not as hefty as other jurisdictions. For non-Labuan entities, you still have the 20 to 100,000 penalties, which is, I think, still okay-ish, but still hefty. For Labuan, is very hefty, it's 1 million ringgit and imprisonment of exceeding 2 years. So for those that have Labuan entities and Labuan activities, please bear in mind that you have your penalties that are much more hefty. And I guess the objective is to make sure that it is not being exploited. The Labuan entities are not being exploited to be within the Labuan jurisdiction, Labuan zone, to take advantage of the tax, but not then provide, in substance-wise, not contributing back to the Malaysian government.
Thank you, Hon Chuan. So I think you managed to cover the one-on-one TP on CBCR. So let's see if there are any questions. Before we look into the questions, there is a very exciting news from our side. So we will be speaking in the transfer pricing conference in Kuala Lumpur that is happening 1st of June 2023 next week. So we're very excited because we will be talking about global minimum tax. Given that is such a hot topic, we're very, very excited about this topic. So if anyone wants to register, there will be a conference that is being organized by MIA, so Malaysian Institute of Accountants. So feel free to look in our socials and how to register. And before we go into the questions, as you all know, these sessions are complimentary. All we ask is for likes and subscribes in our YouTube channel. And what is coming is essentially managing intragroup financing in Asia on 29th of June, managing intragroup services in Malaysia, 27th of July, profit splits versus traditional methods in August, and our transfer pricing conference 1st of June. With that, let's see if we have any questions. So the first question is, will there be a session to have an understanding on APA? Well, we haven't thought about it, but maybe we should do a session on APA. Thank you so much for the session suggestion, because we're always looking for topics. So definitely something that we will keep in mind. The second question is it mandatory to describe the nature of other related party transactions, not covered transactions, in the TP doc? If yes, how detailed should they be described?
Well, I guess I'll have a take on this. Again, I think we are trying to tell a story, right? So if you sort of, depending on what you look at, when you look at non-covered transaction, you're not testing it, why, then I'll presume that you would have to justify why you're testing in the first place. And that, I would imagine, no matter how detailed it is, it'd be good to actually tell a story that the IRB will understand, right? You can't just tell them just a one-liner on the transaction and then leave the IRB hanging. And then obviously then they'll come back and ask you, what is this, right? Why not inform them what it is in the first place, the nature of the transaction itself.
Thank you, Hon Chuan. I think that was the only other question. So with that, we can end this webinar for today. If you need to reach out to us, these are our details. Follow us in our social media channels. We are always putting relevant and interesting content. Thanks everyone for attending to our webinar for today, and we look forward to our June webinar on financing.
Yay, thank you.
Thanks.
All right, bye.